Let me ask you something simple. If I told you that you could build your entire investment portfolio with just two ETFs and still crush the market over time, would you believe me? Because the truth is, you can. In fact, while most people spend hours trying to pick individual stocks, chase trends, or hop in and out of the market, a smart investor builds a long-term plan. And that plan? It can be as simple as choosing two powerful ETFs that balance growth and income. So today I'll show you exactly how just two ETFs could simplify your portfolio, reduce your stress, and potentially make you wealthier than 90% of investors out there. No fluff, no hype, just the real deal. All right, let's get into it. First, we need to define what these two ETFs should represent. One ETF should give us broad market exposure, the classic S&P 500 or total market kind of coverage. The second ETF should be focused on income, something that pays you dividends consistently. This combo gives you the best of both worlds: growth during bull markets, cash flow during downturns, and stability when things get choppy. So, what are our picks? ETF number 1, VOO, Vanguard's S&P 500 ETF. This is the powerhouse of long-term investing. When you invest in VOO, you're not betting on just one company. You're betting on the 500 biggest US companies all at once. Apple, Microsoft, Amazon, Google, Nvidia, all included. Now let's break this down. VOO has an expense ratio of just 0.03%, which is almost nothing. That means for every $10,000 you invest, you're paying just $3 per year in fees. That's less than a cup of coffee. It also has a long-term annual return of around 10% per year. That's not a guess. That's the average over the last 50 years for the S&P 500. So imagine this. If you invest $10,000 into VOO today and leave it alone for 20 years, earning a 10% return annually, you're looking at over $67,000 without adding another dime. Now, that's the power of compound growth, but growth is just one side of the story. We also want income, and that brings us to ETF number 2. SCHD, Schwab US Dividend Equity ETF. If you follow dividend investors, you've probably heard this name a lot. SCHD is like the golden child of dividend ETFs, and for good reason. First, it focuses on quality companies with strong cash flow, healthy balance sheets, and consistent dividend histories. These aren't just any dividend stocks. These are companies that know how to take care of shareholders. SCHD has an expense ratio of just 0.06% and offers a dividend yield of around 3.5% to 4%, depending on the market. So let's do some math. If you put $50,000 into SCHD, you could be earning around $1,750 to $2,000 a year in dividends alone. That's $150 to $170 every single month, whether the market is up or down. And because it's invested in companies like Pepsi, Verizon, Texas Instruments, and others, it tends to hold up well, even during downturns. So when you combine VOO plus SCHD, what do you get? You get growth, you get income, and you get peace of mind. Let's look at a few simple portfolio examples. Scenario 1, 70% VOO, 30% SCHD. This is a growth-focused investor who still wants some income. It's great for people in their 20s and 30s who are building wealth but want to start creating passive cash flow too. Scenario 2, 50% VOO, 50% SCHD. This is a balanced portfolio, perfect for someone in their 40s or early 50s who wants both growth and income in equal measure. You'll still get strong returns while building a solid dividend stream. Scenario 3, 30% VOO, 70% SCHD. Now we're talking retirement mode. This is for the investor who wants to live off their dividends. You won't get as much growth, but your monthly income could easily replace part of your salary. Let me show you an actual 10-year backtest comparing VOO and SCHD side by side. From 2013 to 2023, VOO returned around 230% in total, including price and dividends. SCHD returned around 200% over the same time period, with a more consistent dividend stream. Now imagine combining them. You'd have smoothed out volatility, reduced drawdowns, and enjoyed a steady return with cash in your pocket every quarter. And here's the beauty of this 2 ETF approach. You don't have to watch the market every day. You don't need to time entries or exits. You don't have to gamble on tech IPOs or meme stocks. You just buy and hold. Let's say you're starting with $100,000. If you do a 50-50 split, $50,000 in VOO could grow to about $130,000 in 10 years. $50,000 in SCHD could generate $2,000 per year in income and still grow to nearly $120,000. Together, you're looking at a $250,000 plus portfolio with over $16,000 in dividends collected over that decade, all from just 2 tickers. Now let's answer a few common questions. Question 1. Why not use a total market ETF instead of VOO? You can. VTI from Vanguard is a great alternative to VOO. It includes mid and small cap stocks too. But historically, VOO has been slightly more stable and delivers similar returns. So it's a personal preference. Question 2. What about taxes on dividends? If you're investing through a retirement account like a Roth IRA, those dividends are tax-free. If you're using a taxable account, yes, you'll pay tax. But qualified dividends from SCHD are usually taxed at a lower rate than regular income. Question 3. What if I want to add a third ETF? If you want more diversification, consider adding VXUS, Vanguard Total International Stock ETF, to get international exposure. A 60-30-10 split with VOO, SCHD, and VXUS gives you a truly global portfolio. But for most people, especially beginners, just 2 ETFs are more than enough. So if you're tired of overcomplicating your investments, if you're done with chasing trends, and you want a strategy that works while you sleep, this 2 ETF portfolio is your answer. It's not flashy, it's not exciting, but it works. And it can seriously build wealth over time without driving you insane. If you got value from this video, give it a like, and don't forget to subscribe to Money Stick Unfiltered, where we break down real investing strategies with zero fluff and a stickman by your side. Thanks for watching. Let's keep it simple, and let's keep growing.